I also think an important metric the most Fed members were looking for was the labor force participation rate. And I think they also had the hope that this rate would come back higher, but it actually didn't, because, well, what are your takes why this rate?
So I think there's a couple of things. I mean, look, we sort of thought that maybe it could tick up a bit. Maybe some of those lunar millionaires might find themselves less wealthy than they thought, and couldn't retire in their mid-20s and might have to go and get a real job. But it hasn't happened so far. I think one of the things that we're grossly underestimating is the impact of COVID and long COVID on the labour force. The UK did some research via NHS data, which is much more granular than stuff you can get in the US, and it suggested as much as 1% of the labour force was permanently out of the market, either because they were suffering conditions from long COVID, or they were caring for people who were suffering conditions from long COVID. And in fact, there was a Wall Street Journal article just this weekend, and I can't remember, but the numbers in it were extraordinary. I think it was between those people caring for who think they had COVID or were caring for people with COVID, the number was 6 million. Right? So this thing is not going away. And the implications are, I think, profound. And that participation rate drop is a body blow to the Fed, right? It's a body blow to the Fed, because they hope, this is the thing that people don't understand. Even if the inflation goes away tomorrow, you still have an economy which is growing above trend, where the dispersion between, the amount of jobs on offer and the amount of people available to work those jobs is at historic extremes. And the Fed cannot allow that to persist. So even if the inflation goes away, they still have to keep hiking to right-size that demand and supply metric in the labor market. Otherwise, you're going to ingrain those inflation expectations into the system via higher wages. And yeah, I mean, our models show that wages have probably peaked. I prefer to use Atlanta than average hourly earnings, which is a pretty crappily constructed survey. But they still suggest that even if we've peaked at maybe 6% year-over-year wage growth, we're still likely to grow at 5% well through the end of this year. And that's just too bloody high.
Great. Yeah, great insights, Julian. Well, let's jump onto bonds market. High correlation to bonds have actually inflation expectations. And inflation expectations have a high correlation to the crude oil price.
Yep.
So as we see in the macro world, many things are actually connected. What do you think, or what's your take currently on the bond market? Where should investors, institutional money position currently on the short term or long term?
Well, I wouldn't touch the US. I wouldn't touch Europe with a barge pole. I mean, I think Europe is extraordinarily vulnerable. I think the ECB is in a horrible, horrible place. Still squeezed between the rock of significantly rising inflation. Whereas I said, I think HICP could end up in the low to mid-teens. In fact, I think it probably would have got much closer had it not been for some of those special measures that the German government took last month, which kicked in to help ameliorate some of the price pressure, and a stagflationary weakening economy. So, but I just wouldn't touch it, because if they try and hold back, the risk is they'll lose control of the long end of the bond market. And as I look at things technically, I think the most obvious target for bonds is around 260 in 10-year bonds. So I wouldn't touch Europe. Yeah, I don't like it. Japan, I think they're not going to do anything. I actually think they're just going to continue to intervene as long as Kuroda is there. Ultimately, you will get change. I mean, I think the upper house election and Abe's unfortunate assassination changes some of the conditions there, but that's kind of a story for next year, which really leaves the US. And as I said, I'm more inclined to look at the bull steepness. So the long end remains under pressure or doesn't really rally, whereas you play around betting on, depending on the data flow, betting on, how high rates will ultimately have to go. And I think, in that regard, I think that we priced a ton into the US curve because people almost all the heavy lifting that was being done in terms of tightening financial conditions was having to be done by the bond market because the balance sheet hadn't kicked in, Lucas, right? But I've actually written lots of work suggesting that really the much more powerful instrument is this balance sheet. I mean, we say, you know, the Fed created a crack addict to whom they've become beholden in sense of how much liquidity they've kind of pushed into the system. You know, the market's sitting there going, you know, and they don't really care how much they pay for their drug hit, right? So the rates aren't really important. What's important is they got to have that quantity, if not more, of the drug. And so once you take the drug away in the form of that liquidity via the balance sheet, that I think is going to be really, really powerful. And as we all know, come September, we ratchet that liquidity drain up pretty damn tight.
Yeah, and I think also if you talk about Europe and the currency exchange rate, Euro US dollar, we can basically see that all the sentiment and news surrounding the natural gas flows towards Europe, but also the ECB policy play a big role in the current trading of these exchange rate. What do you think about Euro US dollar parity? What do you have an opinion on the exchange rate?
Yeah, I mean, look, structurally, I think the dollar ultimately will end up in a much weaker place, but we're clearly not there yet. It's going to take an enormous degree of pain. It will force the Fed to make a choice in terms of, you know, do they support the equity market and the bond market, or do they let the currency go? I think that's exactly where we're going to go there. We got there in the late 60s. That's what led to the collapse of Bretton Woods, but we are absolutely not there. The terms of trade shock for the Eurozone is enormous. The utter inability of the ECB to maneuver itself outside of a wet paper bag, frankly, I think is damning. They don't show the resolve, at least certainly at a board level. They don't show the resolve to try and get on top of things. I think a stagflationary outcome is a certainty in Europe. It's almost the worst scenario that you can expect for the currency. And technically, if you look at the euro, and I'm rather hoping it gets there when I get to Europe in August. So I wanted to accelerate quickly because the shopping will be good. But I think that if you look at it, we put in arguably a head and shoulders top on a monthly chart. We broke the neckline perfectly. I mean, technically, the target's the lows of 2000, 2001. So it's sort of like the low 80s, basically.
Yeah. So basically, also not the best news for us Europeans.
I mean, no, it's not, I'm afraid. But I think, you know, what it does do is typically, if you were to get the dollar to move to those sorts of levels, right, because it won't only be the euro that will take that pain. If you were to move to those sort of levels, I think what you'll get is a rise in the dollar, which is typically associated with blow-off tops and crises. So I think at that point, we'll get some sort of crises. That's where the Fed will probably start to back off, because that will have profound implications, a euro going to that level. You know, whether it's on corporate earnings on this side of the pond or not, or on other things, on emerging markets, for example, that'll typically cause the Fed to have to back off. But it's going to be a very painful exercise, Lucas, and a 16% drop in the US equity market ain't enough to reflect that.
Crazy. You also touched the topic emerging markets. I also talk a lot with asset managers and institutional money managers over here, and it seems like the emerging market trade is trying to find a comeback here. Mm-hmm. What's your opinion about emerging market equity, emerging market debt, and emerging market currencies, especially with an environment where we have king dollar, where we have sky-high food prices, and in general, weak currencies? Yeah,
I mean, in this environment, you don't touch them in any way, shape, or form. Currencies, bonds, equities, nothing. You know, I was personally quite heavily trading these things, you know, towards the end of last year and the first sort of quarter of this year. And then, and even got quite excited. We were starting to see some breaks, particularly in places like Brazil. You were starting to see the currency start to break. It was the only currency that had sort of broken Brazil had broken its uptrend line from the lows of the dollar in 2011 and 2014. So that was quite encouraging. And then this whole thing fell apart as the Fed got increasingly hawkish. And until that changes, you can't touch these things. You can selectively trade them. Maybe you can trade a bit of the China story, but I think going forward, we all have got to be cognizant. And I think Russia is, we've been writing this for 2 or 3 years now, that the world was fragmenting and that we'd sort of seen peak globalization and peak what we refer to as laissez-faire corporate capitalism. So this sort of assumed right, Lucas, that you can just move your portfolios and move your investments anywhere. Because for those of us who are old enough, and if you just said to Ford in 1987, before the collapse of the Berlin Wall, you should go and open a factory in USSR and sell your products there, they'd have looked at you like you had 2 heads. And yet, everyone assumes that Elon Musk's going to be able to do that ad infinitum. Well, at some point, I think the guy's going to have to make a choice over which passport he ends up owning. Is it a Chinese one or is it a US one? Because I just don't think, as you move into this new Cold War, which is now, it's been obvious for 2 years, but is now actually happening, those rights just get trumped by government changes, right? I mean, the financial markets have to learn that there is only one ultimate jury, and it ain't them. Jury, judge, and executioner, and it ain't them. So I think, I like some of these emerging markets, but now is not the time to own them on an absolute basis. Maybe on a relative basis, you can trade them. And certainly the currencies look kind of interesting. But as I said, the dollar's not yet at that point where you see a rate of change, which typically is commensurate with it peaking. You've really got to push this dollar really hard. I mean, we refer to this move that we're seeing now as a napalm run in the dollar. And typically dollar cycles end with this napalm run. And if you think about a napalm run, it's pretty unpleasant, because typically at the end of it, if it's left unrestricted, you end up with just a bunch of charred bodies and smoking holes. And that's what happens when the dollar starts to rally in a risk-off environment, because it's the denominator of almost everything that we trade, Lucas, right? Even, you'll have German clients, listening to this now, who'll be running dollar books, right? Everything will be benchmarked back into dollars. And, when the denominator of that book starts to rise in value, it typically crushes the value of the asset. So in a risk-off environment, when those assets are falling anyway, if then the dollar is rising, you get that double whammy, and it's a very unpleasant place to be. So typically that's kind of the end game, but we're not there yet.
Great. Julian, let's finish this thing off talking about commodities. I'm myself knee-deep into commodity research. So maybe let's focus on 2 segments of the commodity market, which is energy and metals. Energy corrected sharply during the last few weeks, mainly because of news of slowing economic growth and also recession fears. Do you have a general opinion about the oil market, also regarding the structural under investments in this space, as well as, this, as I call it, fairy tale of spare capacity regarding the OPEC?
So, look, I mean, as I said, I was playing these things quite aggressively, and I ran the oil trade quite aggressively up until a few weeks ago, personally, and then sort of cut stuff out, reasonably close to the top. But I got caught on one ag position, which just took my eyes off that one. Anyway, swings and roundabouts. I think that we must underestimate the run up in product, right? Because even though crude wasn't up that much, product was kind of equivalent to around a crude price of $200. So this has really been an extraordinary run up in product. I do believe in the structural issue. I do believe that these are quite, energy is attractive But once again, it goes back to this, look, if we're going to end up, as I think, with another leg lower at some point in equities, right? As I said, we've priced in quite a lot into equities going into earnings. We're all worried about earnings, but we don't know whether the shoe drops this quarter or Q3, right? Let's say that companies can pull the rabbit out of the hat, as we say, they can pull off the Houdini trick, right? And the numbers beat, which they could do, right? The headline numbers might beat because the last quarter we weren't showing that much weakness yet. There's still a ton of momentum in the economy. And then they kind of warn, but not enough for the net. They're cautious, but they're not outright saying, oh my God, pull the ripcord right here, right now. And we keep this game going. Then I think, you could get some rotation again in these markets. And I think we're in, and if you go back and look at the dot-com bubble, which is where I think we are, and you look at, say, growth value, right, you can see that we're about halfway into what was ultimately the correction in growth value after the dot-com bubble. And arguably, the excesses this time were even bigger in growth than they were back then. But you could replace growth value with commodities and the US equity market, right? Or whatever you wanted to do. So I think the problem is that initially, until the dollar broke, Lucas, and this is the key thing, until the dollar stopped rallying, the correction in the ratio between growth and value, or as I said, US equity market versus commodities, right, which we all know is super extended on the US equity market on a relative basis, was what I refer to as nasty in nature. So nasty means that everything went down, right? Sure, commodities did better than US tech, where the real excesses were, but everything fell. So on an absolute basis, you couldn't really own anything, right? You lost money in everything, right? On a relative basis, fine, but there's not every investor can do those. I mean, I've been running some of those things, and I advocated, getting back into things like XME relative to the S&P recently, because it's come back to a long-term trend line again. But it means I have to run the short against the S&P. Right? I'm short the S&P, long XME, and I have to trade that kind of relationship. So I think that's the problem with commodities. It's not that I'm not structurally bullish, but it's going to we haven't had that VAR event. We haven't had that really internal shock to broad risk taking. The pros have been tremendously good at hedging themselves. I mean, I was looking at something today. Equity hedge funds performance index is down about 5 to 6%. That's about the first time in 20 years that these guys haven't underperformed the equity market, right? Because typically they go into this thing, loaded up to the gunnels with risk and get murdered. But they saw this coming. The pros have successfully hedged this move, and that's why we haven't had the big puke yet, right? This has been an incredibly orderly decline in equities. Now, I think that puke comes when the retail and high net worth client base has to end up discovering that the Fed put is not there anymore, and the pain has to get greater. And then once that happens and the dollar goes, then you can go absolutely long oil and absolutely long commodities. Otherwise, I think this is still a relative gain, because this is the nasty correction. So once that happens, the dollar goes, the Fed pivots, then the nice correction starts, where the ratios, the US still underperforms massively, which is what happened from 2002 to 2008, right, when the dollar fell. But those commodities and emerging market plays absolutely outperform. We're not there yet.
Good. You touched one thing there that I would like to ask you again about. You say the Fed put doesn't exist anymore. Could you explain a little bit more about this?
Well, I mean, look, this is, if you go back and you look at the Fed put came in under Greenspan in 98, okay? The Fed put came about because an increasing concern about disinflation coming to levels which ran you into the zero bound, right? We've been in a disinflationary world for about 400 years, right? I mean, it's just the nature of productivity. But we hadn't got close to zero on the risk-free rates, right? And obviously we are now. And then Greenspan started to get concerned about this. In fact, as early as 2000 in the policy space, we were talking to these guys about some of these issues. So that's where the Fed put came about, and we saw it in a marked way post the GFC, right? Whenever the equity market wobbled, because if you're concerned about deflation and disinflation, your priority is the wealth effect over the bond market, right? You'll come in and you'll do whatever it takes to kind of prop up those asset prices and keep that consumption going. And if the bond market sells off, you don't really care. If you move back into an inflationary world, and I really don't think people have focused significantly enough on what these guys said at the Sintra conference in Portugal, right, where they all structurally admitted that the world is very different now. Okay. If you do that and you're back on that inflation focus, then your focus has to be essentially the bond market and less so the equity market, right? So you're more concerned about maintaining stability in the bond market. You remember, primarily sort of remit of central banks is to keep governments solvent, right? Not to keep equity investors bailed out. And so, you know, you'll solve the equation for the bond market, right? Now that doesn't mean that ultimately, if there's enough pain, right, drop this US equity market, broad market, 40%, getting the NASDAQ down 60 like it was kind of like post the dot-com bubble, right, that you won't pivot at that point. But it does mean that when you're trying to solve for inflation rather than deflation, the metrics are totally different, Lucas. Mm-hmm. And that's their focus at the moment, right? I mean, that's absolutely clearly their focus.